You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good morning, Jim, and it's good to be with you.
A green board across the board. Oil, gold, silver, commodities, everything seems to be up today. Yeah,
they're up all right, and the U.S. dollar is down a little on that one. A great blessing. The U.S. dollar is actually down 0.6%. So, but what we're looking at here, Jim, is recall back just a brief while ago to January, the extreme bleakness there. And that was largely tied to weakness in crude oil. And the street really can't stand too much deflation. So here we are. Fortunately, we had some timely calls on this because we were looking for a seasonal low in crude oil in December, January, that sort of window. It varies from year to year. And we're also looking for a seasonal low in crude oil, or in copper. Typically that one can be sort of November, December. But it attempted to stabilize then, but because of the hit in crude into January, it pulled the base metals down as well. So they became quite oversold, and you've got the rebound, and this is largely seasonal. I don't think it's anticipating any great economic strength. Just consider how long the bear market has been on for most commodities. The very vigorous cyclical high in 2011, which triggered off all kinds of technical work we do, and we called for a cyclical bear market then. And we keep looking at these lows to see if you can have a big ending low in here rather than just a trade. And this is just a trade out to, our original target was out maybe through March, maybe into April, and this is working on. So it's getting quite popular. Of interest is that even the contract for iron ore, which was so dismal, has been rallying quite strongly. And then the other day, a chart went by, I saw one of lithium, the metal, the rare earth type metal, and it has been soaring for the last year and a half. So there has been places of sunshine in the overall decline in base metals. So it's, let's call it a rebound from exceptionally oversold, helped by seasonal forces, and it should play out in the next 4 or 5 weeks, just depending how fast it gets really overbought. And then today it's being helped by, you've got the U.S. dollar down a good whack, more than 0.5%. So that's where we were saying all the signs are green, pluses all over the place.
Canada also set a record for exports, $46 billion worth of goods sent outside the country. Is that just because of the low loonie?
That would be helping, but unless you can look at the mix of the products they're selling, I'm not a strong one on currency depreciation. It is essentially state theft, where government issues bonds with the dollar at one price and then pays them back later with cheaper dollars. It's been a scam that's been on for a couple of generations of economists and central bankers. It really, Canadian business and industry doesn't need the help of a continuous cheat with the weakening Canadian dollar. It just helps government finances. That's what it's all about. And then when the Canadian dollar has rallied quite nicely since around Christmas time, and but when it was bleak and the headlines were on, the explanations would come, and one of them that offended me quite a bit was that, this would be great for tourists. So Canadians should suffer a weak currency, so some tourists can come and enjoy themselves. I don't go along with that one. And it also is, of course, with this, it just plain feels better when you've got rising commodities. And but as I say, this one's going to be kind of brief. With this, you've had an improvement in the junk bonds. Of course, what part of which was pulling down junk bonds was that there'd been a whole lot of junk issues done on the energy side, and then people found out that this was had a problem servicing debt. So you've also had relief here. The yield for various classifications of junk have come down. You've also had, they've come down in yield relative to treasuries, so credit spreads are narrowing. And that there's also a seasonal component in that one. Narrowing could maybe go into April. But we want to back up here to last year when the credit spreads reversed to widening in June. We looked at it and compared it to the pattern in 2007 and 2008, also 1998, which was a bleak year in the markets, and noted that if widening broke to new highs in late July, it would likely push off a number of financial problems. Well, it broke to new wides in early August, and then pushed off the problems in the Shanghai market and everywhere else. And that, as we recall, the first sharp hit concluded at the end of August. There was some relief, and then the next leg came in and concluded in the middle of January. So credit spreads have been narrowing, which the street finds a comfort. The other one that was bad for the banking stocks in U.S. and in Canada and elsewhere was the yield curve was flattening, and when a curve steepens, it's friendly to the spreads in the banking, generally banking, and when it's going the other way, it's unfriendly to banking. So the yield curve has been quiet for the last few weeks, so that's helping the bank stocks as well. So on this revival of some positive attitudes, we welcome it. It was natural due to the severity of the decline and almost panic type of thing. And it's also natural because it's seasonal. So we're watching as we usually do, for the exit on this, and enjoying it while it lasts.
Canada this week got rid of the very last of its gold reserves. Was that a good move?
You got to look at these central bankers. They've learned all of the theories of portfolio management. So to sit with gold as a reserve, which the lease rates on gold are very low, you're not showing any returns, they're very uncomfortable with it. Also, there's, I think, lingering memories of the discipline that a gold standard imposes on policymakers. So they don't like gold. It's pure and simple. They just don't like gold. So and I think the chart I saw on the gold position was hard to figure out whether it was price or ounces of gold, but at any rate, it looked like the selling of a small amount of gold occurred with the change of government. And I don't know whether there's any politics there or not, but generally the team at the central bank don't like gold because it represents discipline, and so they kicked it out, or they were even down to selling gold coins. And again, we note that they're selling at a low price. They're not selling at $1,900. They're selling at a much lower price. And it reminds of England in the 90s, after 1998, when long-term capital management failed. There was, I think, a 400-ton gold position that the LTCM was short, and it had to be all handled and got off the books and everything else. And as part of all that manipulation, the Bank of England was persuaded to sell the last bit of England's gold right down to $253. So they've got this idea, as I said, of portfolio management for a central bank reserve, and they want to get a better return of that money, and so some places they've been buying equities, which is totally insane. The problem is they just don't understand the value of a solid reserve, and have been imposing various nonsensical modern portfolio theory stuff on handling and getting a proper return from it. Let's call it a modern madness.
We'll have more with Bob Hoye right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, what's the so-called Golden Cross?
Yeah, that's two trailing averages, the 50-day and the 200-day moving averages. And when one crosses over the other in a positive fashion, which I think was Friday, it's considered to be very positive for the price action. And there was a lot of comments come out that way, but we looked at it, updated our study on it quite thoroughly, and it's not a consistent indicator. It's interesting, but it's not consistent. So there are other things to look at, like one of the is the commitment of traders figures, which is getting doing what you usually see at near a rally high. So they used it to push up the price of gold and get enthused about it, but it's not a particularly reliable indicator.
Copper prices have increased quite a bit in the last couple of weeks. Is that a more accurate indicator of what's happening?
No, they call it Dr. Copper, but it's the metal with the PhD in economics. But at any rate, it's just the same thing. Very oversold, somewhat near a seasonal low on a recovery. And again, we're watching this watch for it to become overbought. So, and who knows? When it's there, we will let our readers know. So,
iron ore has picked up as well.
Yep, it's had a good move. Of course, it was completely devastated, and it's had a good move as well. And on the gold shares, there's been some terrific gains there. We were looking for basing action sort of November, December, wanted to see the gold stocks beginning to outperform bullion, which it did, and we advised accumulating some of the gold stocks on weakness with an eye to the big market, which could do a whack, and that, of course, happened in January. So then you had another low for gold stocks in the middle of January. Hoye got down to 99, and recently here it's trading at 174. For an index, that's a huge move. It's been terrific. And but perhaps, we'll be watching for it to get a little overbought and then move appropriately. But it has all the signs of building a cyclical bottom in here. And what we like to see on a week-to-week basis is that there are times when it's going opposite, gold and gold stocks up when the big markets are down. And because in the longer term, in a post-bubble contraction, the gold sector does very well when that very same contraction is making a lot of different kinds of commerce and industry difficult with weak prices. So that's the thing we watch, is that these prices, and particularly like for crude oil, have fallen hugely relative to gold, and crude oil is a proxy for energy prices, and that's an important cost of mining. So the improvement in gold's real price is very constructive for the industry, and as we like to hope, on the big mining companies that were made some inappropriate investments as that 10-year bull market in gold was ending in 2011, perhaps most of the damage from those investments have been written off and their balance sheets cleaned up, and then we can just look for improving profit margins, in which case investors should be in the gold stocks, because they'll outperform the move in gold. Gold is, if you're in U.S. dollars, and you position gold, you're really just trading the currency. So, but if you've been in a weak currency like Aussie or Canadian, the price has gone up. But I really prefer trading the gold stocks, and one should be long. And, well, it's the opposite of the stock market. Buy the dips on the gold market and sell the rallies in the big stock market. And that's our advice for this week.
Bob, thanks a lot for chatting with us.
Jim, good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.